Welcome to this short executive knowledge lecture on topic 4, paper 9 of the SFC licensing exams. This topic covers interest rate derivatives, which are used to manage interest rate risk. And you can see from the screen, specifically, we're going to be looking at both exchange traded and over-the-counter interest rate derivatives. We'll be looking at the pricing of those interest rate derivatives, hedging using interest rate derivatives, and the trading, two very simple trading strategies using or for interest rate derivatives. Now, I'll emphasize the important points to help you understand the core material you need to know to sit the exam, and a copy of the study notes you see on the screen can be downloaded from the Executive Knowledge website. As ever, I strongly recommend that you supplement this learning with question practice that is provided on Examinator.online. Okay, so what have we got here? Exchange traded interest rate derivatives, as with any exchange traded derivatives, have advantages of capital effectiveness, cost effectiveness, and guaranteed settlement through novation that is practiced by the clearinghouses. Now, Hong Kong interbank offered rate futures, that's one of the main products that we will be considering at topic 4. And there are two types of futures, 3-month HIBOR and 1-month HIBOR. We don't have to worry about when they were created, but we will be dealing with those two products later in topic 4. Now, the HIBOR futures contracts are cash settled and designed to enable management, as I said earlier, of interest rate risk. And it's HIBOR, that's the rate which all Hong Kong dollar-denominated instruments are traded between banks in Hong Kong. Now, over-the-counter interest rate derivatives, the majority of them are swaps and FRAs, with some of them being interest rate options. Forward rate agreements, an agreement between two parties fixing an interest rate for a specific period of time, that was dealt with in great detail in topic 2, section 2. So we're not going to spend any time on that topic 4. Now, interest rate swaps, these are OTC derivative products where two parties will agree to make periodic payments to each other. Often the vanilla type of interest rate swap is the fixed for floating. And again, we dealt with that in an earlier topic. The last bullet point under 2.2 I would highlight, and that is in Hong Kong, certain types of interest rate swap transactions are subject to mandatory reporting to Hong Kong Trade Repository, which is operated by the Hong Kong Monetary Authority, if the notional amount is above a certain value. And if it's even higher, then you're subject to mandatory clearing through a designated central clearing counterparty. Now, some issues with regard to interest rate swaps. Swap spreads. Swap spread is the difference between the swap rate, interest rate, and the yield on government bonds. And the swap spread reflects credit risk in the market. So be aware of those points. Application of interest rate swaps. We can use interest rate swaps for hedging and for trading to buy and sell, to out and out make money. Now, there are different variations on the basic concept of an interest rate swap, and we've listed them here on pages 4.3 and 4.4. We've got basis swaps, compounding swaps, overnight index swaps, variable notional swaps, forward starting swaps, and stub swaps. And we've given you details of each of the different variations. I wouldn't be too concerned at knowing these in detail. They're not regularly examined. Now, over-the-counter interest rate options. This takes us into the world of caps, floors, and collars. Now, a cap is where you enter into an option where if interest rate goes beyond the cap and you exercise the option, then the seller of the option, seller of the cap, will compensate you for the interest rate going above the cap. With an interest rate floor, the buyer of an interest rate floor option will be compensated when the interest rate goes below a particular benchmark, and that is the floor. Now, if we combine caps and floors, you can enter into a concept known as a collar, and we're going to be doing an example of a collar in a moment. So the detailed notes there, we're told caps and floors, options that can be bought to hedge against a rise or fall in interest rates. The cap for the rise, the floor for the fall. Seller of a cap will agree to compensate the buyer if interest rates go up, and the seller of a floor will agree to compensate if the interest rates go below a specified strike rate. And right at the bottom there, we're told lenders, investors, can hedge interest rate received by buying floors, so that if the interest rate falls, you're not going to get as much on your investment, but you will be compensated by the seller of the floor. Now, continuing on caps and floors and collars. For both caps and floors, agreements for specified period over a notional amount. Now, it may or may not be the amount that you're exposed to, but that's what the option will be calculated on. And as I said before, collar is a combination of a cap and a floor. Now, very important point, if both cap and floor set at the same strike price, what's the net effect? The net effect is the same as entering into a swap. So please remember that. Both cap and floor set at the same strike price, net effect is the same as entering into a swap. Now, a zero cost collar is where, for example, you buy a cap and you sell a floor, and the amount you pay is the same as the amount you receive. You're effectively not paying anything for the collar. Okay, let's look at a collar example. A bank with 100 million floating rate borrowing, paying 5% interest as an annual interest rate expense of 5 million. Very straightforward. By purchasing a cap at 6% for 1 million, that's the option premium, bank has capped maximum interest rate it will pay. The maximum will be 6%. Because if it goes above 6%, it will be compensated, bringing it back down to 6%. At the same time, the bank sells a floor at 4%, receives a premium of 1 million. So it's paid a premium of 1 million, receives a premium of 1 million, offsets the cost of the cap. Now, should interest rates go below 4%, then the bank's going to have to pay the buyer of the floor, bringing the effective interest rate back to 4%. However, as it says there, with interest rates at 4%, bank interest expense on its loan would fall to 4 million, a reduction of 1 million from the original 5. So that's the operation of a collar, where we buy a cap, sell a floor. Please be aware of those concepts. I would say you could get up to 2 questions on caps, floors, and collars. 2.3.2, top of page 4.6, swaption. Now, it's an option to enter into a swap. And there's 2 types of swaptions, calls and puts. Now, the receiver swaption, which is also a call option on a swap, this is the important point. It gives the buyer the right, but not the obligation, as with all options, to receive a fixed rate. So the receiver swaption or the call option, then the buyer has the right to receive a fixed rate. If they're going to receive the fixed rate, they will pay the floating rate. A pair swaption, like a put option on a swap, gives the buyer the right, but not the obligation, to pay a fixed rate. So receiver, you receive the fixed rate. Payer, you pay the fixed rate. And we're told there's several types of expiry: American, European. Remember, American you can exercise any time up to and including expiry. European only on the expiry date. Bermudan, well, it exists, but we're not told exactly what a Bermudan option is. And then bond options, calls and puts, and this gives you the right to buy or sell the underlying bond. Buyers and sellers of bond options must specify the types of bonds, because there are many, and when they will be delivered. Okay, let's move on to the pricing of interest rate derivatives, the pricing of HIBOR futures contracts. So this is what the fair value would be. Now, the theoretical price, short-term interest rate futures contract, assumes no arbitrage opportunity exists between the futures market and underlying. That's just an underlying assumption. HIBOR futures contract locks in an interest rate for a future period. Now, how would we theoretically calculate this? Well, let's look at an example. Maybe the underlying concept will be examined, but I don't know if they would go into too much detail. So the example reads, assume that there are 30 days before the expiry of the April XT1 one-month HIBOR futures contract, so that the price of the HIBOR futures contract will be the interest rate for 30 days in 30 days' time. Now, we are told by way of the diagram that the 60-day HIBOR in the market is 1.5% and the 30-day HIBOR is 1%. So what is implied by that structure of interest rates? What is the implied 30-day HIBOR in 30 days' time? And we can run through the calculation really just from a theoretical point of view. So if we deposit $100 for 30 days at 1%, we will get 100.0822. If we deposit $100 for 60 days at 1.5%, we'll get 100.2466. So after 30 days, what we receive, if we invest it for 30 days, it should produce 100.2466 because there is no arbitrage opportunities. That means that 1 plus R is 100.2466 divided by 100.0822. 1 plus R comes to 1.001643. Now remember, the R is for 30 days and we always express interest rates on an annual basis. So R for the 365, we take the 0.001643 and gross it up. And we do that by multiplying by 365 over 30. That's just the conventions used in this paper. And we get 0.01999. Well, we can round it up to 2%. So we're saying that given the structure of interest rates that we've been provided with, the implied 30-day HIBOR, and this would be the price in the market, would be 2%. Now, pricing convention, extremely important. Market convention quoting futures prices is to deduct the annual interest from 100. So the price of an interest rate future is not 2%. It would be 98. How do we get that? We take the 100 minus the 2. You must know that for the exam.